Futures trading involves risk and is not suitable for all investors. Content provided in this segment is meant for educational purposes and is not a solicitation to buy or sell commodities.
Hello and welcome back to Pasture to Pin, a bi-weekly series from the Everag Insights team. Each episode, we bring you news and updates on the markets with the intention of helping cattle producers manage their risk. I am your host, Michael Todd Rowen. We are recording from my home office in the Texas Panhandle. Before we get started, let me timestamp this episode. Today is Tuesday, February 6th, 2024 at 3:26 in the afternoon. My main man, Trey, is back with us on this episode as he and I will have plenty to talk about in the cattle markets today. Trey, welcome back to the show.
Good to be here again, MT.
There has been a decent amount of moisture to speak of across the heartland, and the forecast shows more to come. Our friends in the southeast will see moisture move in from the Gulf and work its way up to the Carolinas. The southern Rockies into the southwest will also have some moisture to speak of in the forecast, as well as most of our friends in the northern plains. Trey, take us through a futures market update, please, sir.
You bet. New highs for the move today. Feeders finished up $2.50 to $4 a hundredweight across the board, and live cattle up $1.50 to $3.70 across the board. March feeders and April fats reached Fibonacci's 61.8% retracement from the September high to December low. April live cattle are approaching the gap lower from early November from 187.30 to 187.55. We're seeing some bull spreading action over the last week in live and feeder cattle, with front months gaining on deferreds, which is a healthy sign. Those premiums out in the deferreds are still pretty lofty, though. It's reflecting the trade's expectations of tighter supplies to come in the last quarter. So what's with the big breakthrough higher today? Well, managed money and live cattle showed a net long position at 30,000 contracts on Friday, up almost 13,000 from the week prior. So starting to gain some traction from the funds again, and I assume that's where the strength is coming from today.
Very good. Thank you very much, Trey. The cattle inventory report released last week on January 31st has not only shot some adrenaline into the futures market, but into the cash market as well. Overall, inventory levels show the smallest beef herd since the 1950s, with the smallest breeding cow inventory since 1961. Late week sales last week saw lightweight calves as much as $20 higher. Most feeder steers and heifers are selling $10 higher. Live cash cattle also received a boost and traded as high as 176 in the north and as high as 179 in the south. Cutout prices are fairly supportive of these pricing levels, with choice remaining close to 295 and select hanging out in the low 280s. As we always try to do on this show, we try to answer the question, what does all of this mean? Last episode, we had Antonio talk to us about livestock risk protection insurance. This episode, we will continue with the theme of risk management basics, but we will have Trey take us through the basics of using futures and options. Trey.
All right, thanks, MT. Before I get into the basics, I just want to very briefly lay the ground for what makes an effective risk management plan, because sometimes we view risk tolerance through the narrow lens of whether a hedge position can trigger margin calls or limit upside potential. So this is just a brush up to take a holistic view of your operation. So firstly, of course, identify your risk exposure to adverse market movements. How do they affect your operations' profit margins, cash flow, costs, fixed debt payments, liquidity, availability to capital, and other factors? Where are your strengths, your weaknesses, and which are the most sensitive to adverse price movements? Weigh these factors, use them as the foundation to structure a risk management plan suitable to you, and work with your risk manager to do this. Now, you can plan all you want, but if it's not a plan of action, then you're selling on the market's terms, not yours. This means setting expectations. Want your risk manager to work with you. Market conditions and prices constantly evolve, providing opportunities to implement new positions, adjust existing ones, or address new risks. So nail down how communication will work between the two of you to keep your plan actionable, because again, if markets adapt to the constant processing of new information, then your risk management strategy should too. All right, so to get to the basics, futures and options, they both protect against lower prices. Buy and put options, how do they work? You pay a one-time premium to establish a price floor below the market. What's the advantage? They maintain the potential to benefit from higher prices. Disadvantage of a put option: the coverage does not kick in until the market moves below the floor. Therefore, it's a softer form of protection. Now, selling futures, what's the advantage? The coverage kicks in immediately should the market move lower from the price where you entered the position. Disadvantage of a futures position: you do not maintain the ability to benefit from higher prices. You're locked into the price at which you entered, and you're at risk at paying margin calls should the market advance.
Excellent information. Thank you very much, Trey. Let's put out just a short scenario. So I'm the producer. I am a stalker operator with 60 head of 850-pound stalkers to sell in the month of September, 60 to sell in the month of October, and 60 to sell in the month of November. Now, I'm fairly bullish. I'm fairly certain the market will continue to go up until those respective months. But I also want some level of price protection. So, Trey, the question back to you is, as the producer, knowing what I have to sell and when I want to sell it, how can I use futures to hedge my sell in those respective months?
You bet. So there is a September feeder futures contract for that inventory going out in September. We closed at 273 today. So selling the board, like we talked about, it's a harder form of protection. The coverage kicks in immediately should the price move lower in September. But if the market advances, then of course you're stuck at 273 and you're open to paying those margin calls.
Awesome. Thank you for that. Now, let's say instead of a futures contract, I want to use a put option in one of those respective months or any of those respective months.
You bet. So again, September, trading at 273 right now. A 250 put out there, that'll cost you about $5.50 a hundredweight today. That's about $46 a head. Market's trading at 273. You have a floor at 250. Should the market decline, move below 250, that's when your protection kicks in. But again, if we see 280, 290, $3 by the time September rolls around, then the most you can lose is that premium.
Terrific information, Trey. Thank you very much. If you have further questions on how to use futures and options, would like more information to better understand futures and options, or have any questions about all of the advantages EverAg has to offer, please email Trey at trey.freeman@ever.ag or myself at mtr@ever.ag. You can also call the number below and ask to speak to Trey, myself, or both of us. Thank you to all of our viewers for watching this episode. A big thank you to Paige, who always makes us look our best. Another big thank you to the entire EverAg Insights team for making this show a reality. If you have not done it yet, hit the like button, hit the subscribe button, and click the bell to be notified of future episodes. Until next time, stay safe and pray for rain.